Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are multi-regulated CFD brokers providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. Hello Michael.
Very good afternoon to you, mate. And for those of you watching on video, you'll be able to see that I'm being a model company man this afternoon, sporting my brand new Pepperstone jumper as well.
Yeah, he tried to fob me off with one of them, but I said I'm not having that.
Well, folk who know me will know fashion's never been my strong point. I'm wearing it because it's bloody cold, not for any style points. But
And not because you
nonetheless,
can't afford to turn the heating on.
no, don't you worry about that. It's been an interesting week in markets, though, hasn't it, mate?
It has. We've seen new record highs for the DAX this week, and the FTSE 100 is retesting that top of the recent range around about the 8,400 level. So I think for me, given what we've seen this week with the economic numbers and the earnings numbers, I think we've got quite a bit to get through. Not to mention, obviously, we've got Davos next week, as well as which is usually much ado about nothing. And about as much use as a chocolate teapot. And also we've got the Trump inauguration. But before we get cracking on that, I know you're going to remind me, going to do the disclaimer. So here goes. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So let's start with this week's UK economic data. So inflation.
Well, yeah, I was going to say let's get the worst bit out the way first, shall we?
Yeah. So let's do the monthly GDP numbers, which eked their way back into expansion territory for November, 0.1%, following on from two successive monthly contractions in September and October. But it was still disappointing, wasn't it?
Yeah, absolutely. I mean, as you say, what's the positive? The economy's growing again. We saw a
Barely.
contraction in GDP in September and October, but as you say, ultimately we're talking about rounding errors here. Even the contractions we saw in September and October was 0.1%, essentially, and the rolling 3-month figure, evidence this. The economy's gone nowhere since the back end of August, and of course this is a real issue now, because we've had 3 consecutive months of stagnation, and over the last week or so, and we discussed this last week as well. One of the things markets are concerned about is the fact that the growth the government desire and that they actually need in order to meet their fiscal constraints just is not happening. And this morning's figures will have done little to soothe those concerns, and again point to how risks to the outlook here in the UK, and from a growth perspective at least, remain tilted to the downside. I mean, we're talking about GDP for November, but of course you look at some of the more up-to-date sentiment surveys, both in terms of businesses and consumers, they make for very, very grim reading indeed. And of course, all of this is before the impact of the national insurance changes, which comes in to effect in April. So, not only are things pretty dire at the moment, 0.1% growth is not worth celebrating at all. The factors on the horizon look like things could perhaps get even worse.
Yeah, indeed. Actually, it wasn't 0.1% because it was rounded up from 0.07%. I think what was particularly
Yeah,
interesting,
but that's
though.
like me saying I'm 6 foot when I'm actually 5'11", isn't
Well, yeah, exactly.
it?
But the fact is, you're not 6 foot.
No, because I'm a midget.
You're not a midget, mate. You're not a midget. But, that aside, I think what was interesting about those GDP numbers was that construction was a growth area, manufacturing, poor again, industrial production, manufacturing production saw contractions of around about 0.4, 0.5%, or declines in 0.4, 0.5%. But services actually held up rather well. Now, services is the biggest part of the UK economy. And we haven't even started to digest the various national insurance tax changes yet, and that is the part of the economy that is actually keeping the UK's head above water when it comes to economic growth. So for me, I have significant concerns about the future going forward. Maybe not in the short term, because I think we still got to digest some of the December numbers. But what was, I think, particularly welcome this week was we did see a slight slowdown when it comes to headline CPI, core CPI, and services CPI. So yields have come off a little bit, are buying the Chancellor of the Exchequer, Rachel Reeves, some time, I think.
Yes, I think you're probably right. I mean, certainly Reeves seems to have lived to fight another day or another week, perhaps. I mean, again, you touched on those inflation numbers. CPI at 2.5% on an annual basis in December, below market expectations, bang in line with the BOE's forecast. We also saw core CPI come down to 3.2, services CPI, big fall there, down to 4.4 from a prior 5%, and that's the slowest annual increase since March of 2022. Again, like you did with the growth data, I'm going to pour a little bit of cold water on these figures, though, because actually there were a few statistical quirks in the data. Firstly, the ONS reference date for the CPI figures was the 10th of December, so comparatively early compared to December of 2023. So some of the price hikes that you might have seen around the Christmas period wouldn't have been accounted for in the data. The other thing is that there were various shenanigans, I should say, going on around the airfares component of CPI. And without wanting to go too far into the weeds, effectively what happened was that the ONS were looking at airfare prices on Christmas Eve and on New Year's Eve to calculate how they had changed compared to last year. And also in 2023, airfare prices increased quite considerably over Christmas. So again, a bit of a flattering base effect there. And if you look at where that leaves inflation, moving into 2025, I think you're going to see a bit of a consequence of that base effect in the January data, and inflation will probably tick higher. But then you look at something like oil prices. Brent is trading north of $80 a barrel. Even WTI is up at $80 a barrel now. They're both trading at their highest levels since August. Are we then talking about actually starting to look at more and more upside inflation risks coming back into the equation, which again will make the BOE's job just that little bit harder?
Yeah, I think obviously while it's welcome that we've seen a little bit of a softening in inflationary pressures, when you actually look at some of the costs that businesses are having to absorb on the various PMIs and business surveys, they're telling a completely different story when it comes to cost price inflation. And a case in point there, I think we can look at Whitbread's results earlier today. Premier Inn owner Whitbread, whose shares are currently down 3.5% on the back of their latest quarterly trading update.
Fallen out of bed a bit today, haven't they?
A little bit, yeah. I mean, I think it's disappointing. The numbers, even of themselves, weren't particularly bad. Certainly, I think in the period up to and including the 9th of January, Whitbread shares did see a 2% increase in UK sales and a 37% increase in its German business for that 6-week period. And I said last week that the German business particularly was likely to be a fairly key bellwether, given that it's been an underperformer for quite some time now. But when you stretch that out over the quarter, total sales actually fell 2%, with revenue per room down 3%. They did keep their guidance unchanged, but I think it points to concerns about the direction of travel. And it says, Whitbread say they expect UK cost inflation of between 5 and 6% in its £1.7 billion cost base for 2026.
Yeah, and I think that's the worrying bit. I mean, you told me that number probably about 15 minutes or so ago, and again, I was probably as shocked as you were to hear it. I mean, you're talking 6 or 7% cost inflation, and as you said, they were saying, if they make certain efficiencies, read layoffs,
£50 million worth.
yeah, they may bring that down to between 2 and 3%,
Hmm.
but even that is a level where, from a macro perspective, you would say, if that's mirrored across the economy,
Hmm.
policymakers at the BOE are going to be looking at that and going, we're not going to be getting sustainably back towards 2% in the near future if businesses are experiencing cost pressures of 3.5 times that level.
Hmm. That aside, Ocado's seen a fairly decent jump in its share price over the course of the past few days. Had a really decent Christmas due to its tie-up with Marks and Spencer's, Ocado Retail. Um, Revenue growth of 17.5%. Weekly orders jumping 16.9% to 476,000 in
Easy for
2024.
you
Easy
to
for me
say.
to say. But yeah, I mean, we've seen a fairly decent jump in Ocado's share price, but you have to set that in the context of the fact that earlier this week it traded at 5-year lows. So, how much is it already in the price?
Yeah, exactly. I mean, they certainly delivered in terms of those earnings. You couldn't really
Mm.
have asked for more from that. But yeah, they're coming off a very, very low base.
Yeah.
And also, it is what they were saying in terms of that report was very much in keeping with the broader trend of retail here in the
Mm.
UK. It was a very, very strong Christmas for UK retailers. But again, the question is, was that the sort of consumers' last hurrah before everyone tightens their belts into the new year? Or is that something that's potentially sustainable as we move through into the bulk of 2025? And I think that's probably the key question that investors are going to be asking themselves. But when you look at something like Ocado, as you say, very, very solid results. Trading looks to be going well. And clearly the stock, well, maybe not now, but 2 or 3 days ago, it was looking pretty cheap. So no surprise that the market has reacted so aggressively to that upside surprise.
So for me, I think the key level in Ocado, looking at the historical charts, is that we're now back at the levels we were towards the end of last year, around about 330p. I think we need to break through those levels, which was also the highs towards the end of November, to bring us back to the levels we were in July when it was around about 450p.
Hmm.
So it does have a barrier to get through, and we're sort of punching against that barrier around about 330p right now. So the big question is, can we punch through that and then go back to the levels we saw in the middle of the summer?
Yep, no, I think you're absolutely right there, and your little crayon set there has been right more than it's been wrong of late. So
Well, hopefully, that's why I use them. Crayons are incredibly useful when you want them to be. Okay, so last couple of days, fairly decent performance from the S&P. Switching gears, looking at US stocks, US bank earnings. Really strong numbers from JP Morgan, Goldman Sachs, record revenues, record profits. We've got Trump being inaugurated next week, and there's talk about deregulation. Well, given these numbers, is regulation really holding US banks back? Because I don't, from the numbers that I'm seeing, there's certainly no evidence of that.
no, absolutely not. I would completely agree with you. I mean, I think all of the bank earnings. The guys we had on Wednesday, even earnings from Bank of America and from Morgan Stanley before the open today. Bank of America's earnings per share was a little bit soft, but all the other metrics were pretty solid. Yeah, it has been a very, very impressive start to earnings season from the big banks. You would say they don't need deregulation to help them out, but actually, if deregulation is coming, then that's obviously going to be another bullish catalyst for them. I guess the sort of more broad point is that if banks have clearly delivered and defied expectations, does that now set the tone for the remainder of earnings season? Things start to get somewhat busier from next week. I think we've got Netflix
Going to
reporting
talk
next
about that.
week. Yeah, I'm sure we'll get onto that later
Hmm.
on. And then, of course, you move into the magnificent seven stocks from
Hmm.
the start of the week after. So, given how well the banks have performed, I do just wonder whether expectations were already pretty lofty, probably gone up another couple of notches after what has been a very, very strong start to the earnings season.
Yeah, JP Morgan and Goldman Sachs, as I speak to you right now, they're both trading at new record highs. So,
There you go.
certainly the momentum is there. Interestingly, the S&P is nowhere near close. It's still below 6,000. So I think, as you rightly say, the Magnificent Seven could have a great deal of input into whether or not we start to get a continuation of what is
Mm.
so far been a fairly reasonably positive start But looking at the S&P, we need to get back above 6,000, I think, before I get overly confident that this momentum, this pausing
Yeah.
momentum that we've seen towards the end of November into the end of the year starts to turn and shift back to more positive
Yeah, I mean the
overall.
market. You look at the S&P. We've certainly taken a bit of a pause for breath. In the Nasdaq as well.
Mm,
I think what's been interesting for me over the last week or so, because obviously since we last spoke, we had that blowout jobs report out of the
mm,
US last
yeah.
Friday. 256,000 jobs added. Unemployment coming down to 4.1 from a prior 4.2%, smashing through expectations. And the S&P fell to 2.5% on Friday. We then had cooler than expected core CPI out of the States on Wednesday, and the S&P and Nasdaq rallied as near as makes no difference, 2% apiece. And what that tells me is that the market's focus over the last week or so has shifted away from the underlying economic and earnings story and back to the policy story. And basically, the market is again trading off the fact that actually good news in terms of economic data could well be a negative catalyst and could well be bad news, because it's likely to mean that the Fed go from skipping the January meeting to potentially a more prolonged pause and sitting on the sidelines for longer than participants had expected. So I think that's something that I'd be seeking a bit of a change in dynamic there. If the market does begin to focus back on those underlying fundamentals, which are undeniably strong. We had decent retail sales out of the US today. Earnings and revenue growth is looking good. I would want to see a focus back on that and away from this kind of dependency on the idea of rate cuts to become a little bit more convinced that we're going to make a durable leg higher.
Well, on the topic of rate cuts, I think what we can say, I think with a certain degree of certainty, is we'll probably get one from the Bank of England on February the 6th. I thought we might as well get ahead of that, seeing as you won't be talking to me in the lead up to that particular. But I think we will get a rate cut then. Alan Taylor, his comments actually this week were very interesting. He was calling for a much more aggressive rate cut cycle. I think he's probably going to be a minority voice, perhaps alongside Swati Dingra. But
Mm.
ultimately, I think that suggests that the paradigm is slightly shifting on the MPC towards, you know, a much more aggressive stance. When I say more aggressive, I mean, obviously you still got to get past the hawks.
Mm.
But I think we can expect a rate cut from the Bank of England. Probably won't see another one from the Fed until March at the earliest.
Yeah, I make you spot on that one. I think that a cut from a 25 basis point cut, I should say, from the bank is nailed on for the 6th of Feb. You're probably going to have one or two that dissent against
Mm.
that. Certainly, Catherine Mann and maybe one other.
Maybe Megan
Um,
Green, probably.
Yes, potentially. I think you're right in terms of Alan Taylor. It was his first speech as an NPC member, but of course he did dissent in favour of a cut at the December meeting when bank rate was held steady. So he'd already sort of staked his claim for being on the more dovish side of the committee, and his remarks this week certainly reaffirmed and strengthened the case for him being one of the more dovish members. I don't think his view really represents a consensus among policymakers, and I think very much the idea will still be one of a kind of wait and see approach to policy. We spoke about April being key in terms of the budget measures that were announced in terms of national insurance coming into effect, and I think the bank are probably going to want to see how that impacts the inflation outlook and also how it impacts the labour market before actually embarking on a more aggressive pace of policy easing, which arguably you could say, and I was thinking about this morning, the bank would actually want to be easing much quicker and much more aggressively at this point to try and support growth. But they are simply unable to do it because inflation remains too high and the degree of uncertainty in the outlook is still so elevated.
And the thing is, the problem with waiting till April, Michael, is you're not going to get the data till June.
No.
So that means that potentially you could be waiting for the second rate cut to come maybe by the summer, which is another 3 or 4 months after
Yeah.
February one. So unless you see a significant softening in the data, you know, the Bank of England is going to be caught between a rock and a hard place if CPI is still north, core CPI and services is still north of 3%.
Hmm.
Can you really contemplate cutting rates at a
No.
time when your headline numbers are still well north of 2 and 3.
No, I make you absolutely right. It's not something that they can give serious thought to, and as you say, they are between a rock and a hard place, and I think they just have to remain on the sidelines until they get that data that gives them, as they keep saying, confidence that underlying price pressures and persistent price pressures are fading from within the economy, and you need more than one upside surprise on a CPI print to give them that confidence.
Or a downside surprise.
Well, depending on the way you look at it, yeah.
Yeah, exactly.
Yeah.
Okay, so next week, we'll move on to next week now because I think we've probably done this week, but I think it's a decent segue because Davos is on. I mean, who cares? Honestly,
Well,
I mean,
I'll point you
the
to
bit.
my level of care about it. I didn't even know it was on until you told me in your email yesterday that we'll talk about Davos today.
I mean, every year, Bloomberg, CNBC, all the business channels focus on Davos. They send people over there. They have these little powwows with a nice sort of snowy backdrop. But since the financial crisis, they've had these every year. It's the next big thing, and ultimately they've achieved the sum total of diddly squat. What exactly have they done to improve things from where they were in 2008? Lots of big ideas, lots of central bankers talking to big CEOs and what have you, and ultimately nothing changes. I mean, honestly, it's just a good excuse for a bit of a jolly, isn't it?
Absolutely that. I think you've got it in one there, to be completely honest with you. There is I mean it's a waste of time, let's
Mm.
be honest. As you say, a lot of people going for a ski trip, going for a bit of a jolly up, they'll have a few nice drinks, they'll have some of the old Swiss fondue that they like to dig into, talk a lot of hot air, no real action will come from it, and then we'll come back again this time next year and be in the same situation once more. So yeah, I think it's a complete waste of time, certainly for any market participant to be focusing on that. And actually, there's plenty else for us to get our teeth into next week while they're all off having a jolly up.
Yeah, so let's talk about Trump. President
Indeed.
Trump, 47th President of the United States. He won't be able to serve another term. So it's his inauguration. An awful lot of the media have been basically saying that the turmoil in markets or the bond markets has been on concerns that he will basically sign a whole raft of executive orders and upend the global economy because of tariffs. That beautiful word, as he called it, the most beautiful word in the entire dictionary of words is the word tariff.
I love
Okay,
the dictionary of words as
words.
opposed to any other
Yeah,
dictionary that
scenery.
might be
Yeah,
out there.
exactly. So we could see some fairly rapid executive orders. Um, I did an interview earlier today on it, and to be quite honest, I think that the media's lost its mind to a certain extent because we do have previous when it comes to Trump being a president.
Hmm.
And the world didn't collapse when he became president. Yeah, tariffs came in, but to paraphrase a previous president of the United States, who said that you should walk softly and carry a big stick, or talk softly and carry a big stick. Trump generally tends to do the opposite of that. He basically tends to talk loudly
Hmm.
and promise to hit people with a big stick. And then ultimately there is some consensus and a deal is done.
Yeah, I think you've got it in one there, and we all remember, I'm sure, the somewhat tedious nature of the US-China trade deal that
Mm.
dominated the first half of Trump's initial term in office. And I think that's exactly the way to look at it. Yes, there are going to be tariffs. We know that. It's a negotiating gambit. It's a tool. It's a tactic. It's how Trump does business, and it's how he is going to govern when he is back in office on Monday afternoon in the United States. I think that the key thing, at least initially, for financial markets is going to be what is the nature of those tariffs when they are imposed. So, for example, is it going to be day one executive order, as Trump said on the campaign, blanket tariff on all imports from everyone into the United States? Or is it going to be a much more gradual approach? Is it going to target certain sectors, certain critical minerals, certain key imports into the United States? Or we even had a report earlier this week, I think via Bloomberg and also the Wall Street Journal, suggesting that the tariffs might actually be a phased approach. So yes, it's going to be a 20% tariff, but it will increase by, let's say, 2% a month over a 10, 12-month period to allow time for negotiations to take place and a more convenient arrangement to be found. And I think that's really the key unknown at this point is still what is the nature of that proposal going to be? I think market participants more broadly are still in that kind of worst case scenario mindset of it's going to be a huge tariff on everything straight away. And I don't think that's going to happen. And I'd actually argue that anything that isn't that will probably be quite a significant positive for both equities and for bonds when the market reopens on Tuesday, because of course Monday is Martin Luther King Jr. Day in the United States.
Yeah, I think for clues as to, I think the new Trump administration's approach to this is going to be the new Treasury Secretary, Scott Bessent. I bet you're slightly disappointed if it's not Steve Mnuchin. Given
what, so I could go and moonlight as his doppelganger again?
Something like that, yeah. Yeah. So anyway, so Scott Bessent has indicated already that there's going to be, there is not going to be a day one approach, wham, bam, thank you, ma'am, approach to tariffs. It's going to be exactly what you just highlighted in your summing up. It will be a gradualist approach, because the last thing that Trump wants, in my opinion, is for inflation to start pushing up. He wants lower rates. He wants the Fed to cut rates. And he wants the Fed to cut rates to a level that he's more than comfortable with. I mean, I remember when he was having a go at Powell in his first term, chairman of the Fed, for raising rates or even talking about the prospect of raising rates. He said rates were too high. So, for me, I think there needs to be some, acknowledgement of the fact that the hyperbole that tends to drive these markets generally tends to cause the market to overshoot in one direction. Now, US rates could go, the 10-year could go to 5%. Will it go beyond that? I don't think Trump would want it to. So I think he will be constrained to some extent by what the markets do.
Yeah, I would agree. I mean, let's be honest, fundamentally, Trump is and was a real estate developer, so he's got a bias for lower rates. That's almost in his blood. I think, and I was looking at this earlier on, I actually wrote a very short note on it. Trump's economic inheritance is a pretty good one. You look at the data that we've just had, retail
Deficits
sales.
aside.
Deficits aside, of course, but every president inherits a worse deficit than the last one, or at least for the last quarter of a century. Retail sales, the consumer's doing very, very well. Inflation, finally some signs that core inflation may be beginning to budge a little bit lower, and the labour market still very, very tight. We just had the biggest 1 month jobs gain in 9 months, and unemployment coming back down to 4.1%, as we said earlier on. So, you look at that. You look at the Fed, and we heard from Fed Governor Chris Waller a little bit earlier on as we started this recording, saying if we get more data of this ilk, then don't rule out any rate cuts in the first half of the year. We could even cut as soon as March. Is Trump going to want to put all of that in jeopardy through his trade policy? Absolutely not. And I think this is the sort of message that his more rational advisors and people like Scott Bessent will probably be delivering at this point. It's very much a case of, yes, there are issues with trade. Yes, there are issues with the deficit that we need to solve. We've got 4 years to solve them. Let's not go for a sort of scorched earth policy and ruin the inheritance that we're being given, which actually on balance is pretty damn good.
I was looking at his energy secretary, Chris Wright, and he's been sort of painted as an oil baron and what have you, and a sort of a fossil fuel, what's the word I'm looking for, lobbyist. But when you actually dig into the detail, he's also a scientist and acknowledges the fact that climate change is happening, but he's also a realist. And he realises that you cannot achieve the move to renewables without it being affordable. And he's also on the board of a couple of renewables companies, as well as an SMR company, a single modular reactor company. So again, I think once you scratch behind the surface of all the headlines, the reality is somewhat more nuanced than sometimes the mainstream media would have you believe. And I think that really annoys me, because ultimately you should be able to rely on the media to paint a balanced picture of some of these Trump appointees. And while you don't have to be a fan of Donald Trump, I think you also need to offer a balanced approach to some of the appointees and say that actually he looks a fairly decent pick because he understands the industry and he understands business.
No, I think you're absolutely right. The only thing I would add to that is if we can get this Chris Wright chap to have a word with Ed Miliband, that might do us all a favour.
He could probably have a word with Ed Miliband, but whether Ed Miliband was listening is another matter entirely. But, I don't really want to go down that particular rabbit hole.
No, it's probably best that we don't, because we've got plenty of other things to get on to, haven't we?
So the Trump inauguration on is it the 20th?
It is indeed, yes.
Yes, it's the 20th.
Monday.
Next Monday. Okay. We've also got some other data out next week from the UK. UK wages and unemployment for November, the 3 months to November. I really can't see any sort of, what's the word I'm looking for, encouragement for Rachel Reeves on this department, because I think wages are going to remain sticky for quite some time to come. They're around about 5% already, wage growth, and we did see a big jump in the 3 months to October. I think we did 5.2. I think it's going to struggle to come down significantly from there in the short to medium term. Unemployment 4.1%. Is it 4.1?
It is, yes, I believe so.
Yeah. So wage growth unexpectedly shot up to 5.2% in the 3 months to October. So, is it going to? How quickly is it going to come down from there?
Well, not very would be my my honest answer to that. I think the other thing to bear in mind is that we are still seeing the effects of those above inflation public sector pay rises that were announced during the summer beginning to feed into the data. Of course, this data references November, and I think this is probably the last month that will be skewed by that. But the other thing, of course, to bear in mind is that the unemployment statistics are still incredibly unreliable. Even the ONS themselves, effectively, not quite as blunt as this, say that it's not really worth the paper that it's written on. But even with that in mind, I certainly don't think this is going to bring much by way of good news for the Chancellor or for the Bank of England. Even if we see wage growth cooled by a couple of tenths of 1%, we're still talking about earnings growth that is probably 2.5% hotter than where you would want to see it in order to be compatible with that 2% inflation target that the Bank of England have in the back of their, well, hopefully in the front of their minds at all times. So, I certainly don't think that the employment figures this week are going to do much to change the overall picture, which for me is still one of stagflation here in the UK.
And obviously we still haven't seen. We're going to get to see the minimum wage increases start to filter in to that in the coming months as well. So we're not going to see wages come down. I mean, I don't have a problem with above inflation wage growth when it comes to the private sector if the productivity is there. What I have a problem with is public sector wage growth where the productivity is not there and hasn't been there for the last 20 years.
No, that's
unaffordable.
Right.
That is unaffordable. If the productivity gains are there, then certainly I can absolutely see the case for above inflation wage growth because it pays for itself.
Yeah, and that is the key point. It's not a political argument; it's an economic argument.
It's not.
Because if you are giving above inflation public sector pay rises, but they are above inflation pay rises in general, but they are accompanied by that increase in productivity, then it's not particularly much of a problem because it will increase economic growth, and the upside inflation risk from doing that is much reduced. If you are simply saying inflation is running at let's call it 3%, and we're going to give you 6% as a pay rise, but there's no productivity increase from that, I'm talking on net, not on an individual level, then all you are doing is further fueling inflation, which is already too high. You're effectively hammering nails in your own coffin at that point.
Yeah, increasing your cost base without any improvement in overall revenue or profit.
Absolutely.
I mean, it's economics 101. Why is that so difficult to grasp?
Oh,
Anyway,
Even the simplest things are difficult these days, it seems.
so moving on, public sector borrowing. That's going to be particularly instructive given the fact that obviously gilt yields are where they are, because obviously the cost of funding the additional debt is going to basically erode the Chancellor's headroom. I think she could be in for some good news, perhaps, for December, because towards the end of the calendar year, we do tend to see a little bit of an uptick in tax receipts. We certainly did at the end of last year. I was looking at the numbers for last year, for December, and there was a £6.5 billion deficit in government borrowing. And then in January, we saw a 15.6 billion surplus, which was a record surplus for the public finances over the last 30 years. Though I would caveat that by saying that I would imagine that an awful lot of that surplus was because of people brought forward their tax take because they knew that taxes would be rising this financial year.
Yes, indeed. There's always a caveat. That's the thing with the UK at the moment. Whether whenever and I guess ultimately this is our job to find those caveats. But you look, even when there is a glimmer of good news, it's because of a one-off factor, or because,
Or a
as you
tax
say,
change.
or a tax change, or a policy tweak, or whatever. If you're looking for pure, unadulterated good news, there is not a lot of it out there. What I would say, though, from a sentiment perspective, the data could come at an opportune time, because we are seeing gilts rally towards the back end of this week, and that rally has been kicked off, of course, in the aftermath of the CPI figures that we had out on Wednesday. And if we were to see a decent set of public borrowing data for December, then that could just further, in the short term at least, give perhaps a little bit more reassurance to market participants. But fundamentally, we're still dealing with the same issue we were dealing with this time last week, and actually that we've been dealing with since the back end of October, when the budget was announced, in that we have got, well, we did have 10 billion quid's worth of fiscal headroom. We've probably got about 1 or 2 billion quid's worth of it left. And in order to get that to a more sustainable level over the medium term, we either need tax hikes or spending cuts, and we need them in relatively short order.
I mean, I'm looking at the gilt yield, the 10-year gilt yield on the 31st of October, and it closed at 4.445, so 4.45%. It's been up to 4.9% in the month since then, and it's now currently at 4.76%. So we're 30 basis points above where it was at the end of October, and we're 15 basis points down from the peaks of earlier this week.
Well, if you want an even more shocking comparison, because I'm sad, I've had this chart open on my Bloomberg here for quite some time now. On the 4th of July, which was election day, the 10-year gilt closed at 4.19%. So you think about the move that we've had since then. Yes, we did rally up until about mid-September, but since then it has just been complete one-way traffic. And actually, just looking here, the lows that we saw in September were 3.75%. So that's a 110, 115 basis point sell-off over the space of 3 months, effectively.
Right, for the purposes of balance here, okay, because I know
you're going to say it's a global move, aren't you?
Yeah, but what's the equivalent US move?
Talk amongst yourselves for one
That's all right.
moment.
Because what I can do is basically I can now look ahead while you're doing that. We'll move off public sector borrowing, because we've got a rate decision this week, or this coming week, from the Bank of Japan, and they could well be hiking rates by 25 basis points. And I think the odds of that have increased because of something that Governor Ueda suggested earlier this week, that a hike could be up for discussion because of wage growth in the Japanese economy, as they look to move their headline inflation number back to 2% for the first time in about 30 years. Or is it 40 years now? Yeah.
Oh, well, it's a hell of a long time, one or the other.
So
I've got
they're
an
raising
answer for
rates.
you, by the way.
Oh, you have? And?
I have, yes. So in the United States, looking at the benchmark 10-year Treasury, that's up 25 basis points since early July, since the election in the UK, and it's up about 95 basis points from the lows in September. So yes, it's a global move, but the UK has underperformed. The BOJ is an interesting one.
Mm,
I mean, I think personally, a hike is pretty much nailed on at this
yeah.
point. We had reports out in Bloomberg overnight Thursday morning, for those of you who are listening to this later on, that the BOJ are planning to hike rates unless there is market turmoil in the aftermath of President-elect Trump's inauguration.
Mm,
So I think one of the interesting things about the BOJ actually is over the last year or so they've had so many of these sources reports before the meeting. It's almost pointless having the damn meeting in the first place because we know what they're going to do by the time it comes around.
mm.
But it is interesting that they are continuing to hike rates. I think the BOJ, and I've discussed this previously, I think with yourself, their window to tighten policy is a very, very narrow one because, of course, they're moving in completely the other opposite
Yeah,
direction
but
to
just
all of their
remind people
G10
where their
peers.
rate. Just remind me where their rates are, Michael.
Well, it's only at a quarter of 1%.
Yeah, exactly. So
And we're going to move to
4.5%
half of
below,
1%.
four and a half
Um,
percent below our rates.
No, I completely agree. But the
Yeah.
issue for the BOJ is,
Mm,
if they were to, let's say, and they're never going to do this, but let's say
mm,
they were to hike 25 basis points every meeting,
mm,
dollar yen is going to fall through the floor, which is then going to impact their achievement of that 2% inflation
mm.
aim that they're desperately seeking. So they do need to go relatively slowly and relatively steadily. And I think actually one of the things that's probably helped them out is the fact that the Fed have turned much more hawkish over the last kind of 3 weeks compared to where they were in the third quarter and early fourth quarter of last year. And I think that's just given them a little bit more room to maneuver to actually go, yes, we can probably squeeze in another hike now, and actually probably finally woken up to the fact that if you want to hike, you better do it sooner rather than later because everyone else is moving in the opposite direction.
So if they hike this coming week, their headline rate will be 0.5%.
Indeed, yes.
So that gives you an indication of how much of a problem Japan has had on the inflation front. And they've had to depreciate their currency quite aggressively to do it.
Yes, indeed. And they are still, although they have depreciated the currency, they are still very, very jittery over potential further weakness. I mean, their finance minister was on the wires earlier this week talking about yen moves potentially becoming disorderly, and it looked like speculation was coming back into the market once more. So maybe that yen intervention story is another one to watch.
I'll let that pass.
You missed my Ocado pun earlier,
No, I
so.
didn't. I deliberately ignored it. I deliberately ignored it. I thought I'm just not. I was tempted to get the cards out. They're just down there, but I'm not doing it. So, so we really need to wrap this up. So we've got manufacturing and services flash PMIs for January. Not expecting any good news there from Germany, France, or the UK, and they'll just reinforce, I think, the narrative that manufacturing is in a depression.
Mhm.
Services is about the only part of the economy that's holding the various economies up. Obviously, Germany contracted for the second year in a row, 0.2%, largely as a consequence of their weak manufacturing sector. So not expecting anything there. In terms of earnings, we've got EasyJet, first quarter. Not expecting any great shakes from there. The airlines generally don't do very well in the first half of the year. EasyJet made all of its profits last year in the second half. I think the one thing that I think we do have to think about when we look at EasyJet is they've got a new CEO now. Kenton Jarvis is taken over from Johan Lundgren. EasyJet Holidays is a key growth area, continues to outperform the rest of the wider business, and they're looking for, I think, capacity to grow by 3% in 2025, and EasyJet Holidays is also expected to grow by 25% from a base of 2.6 million customers. So I think for me, this Q1 update is to do with how their expectations changed for 2026, 2025, 2026 going forward.
Yeah.
We've also got JD Witherspoon, second quarter. Their share price has really struggled. But they're actually doing all right. I really don't understand why the business is not being the outperformance of the business is being reflected in the share price. So again, we've got them. They're due out on the, where is it?
22nd.
22nd. EasyJet the 22nd.
According to my reliable source, anyway.
Yeah, Harbour Energy fourth quarter, 23rd. Netflix. Let's talk about Netflix because everyone I know has got a Netflix account.
One to watch.
and definitely one to watch in the context of the US earnings story, because then it's the Tesla the week after,
Yeah.
and then obviously you've got the Magnificent Seven the week after that. But I think for me, Netflix is an interesting one because it continues to blow the likes of Apple, Amazon, and Disney into the weeds when it comes to streaming content, and their share price is still pretty close to the record highs that it posted during December, despite the fact that their subscriber growth is slowing down quite markedly.
Yeah, and I guess that's going to be a problem for, well, I think certainly for Netflix, given as you say that pretty much everyone has a Netflix account at this moment in time. So you question the degree to which they've ended up saturating their own market. But also, not only that, everyone also has, or most people have, an Amazon account and a Disney account and an Apple account, or one or two of those. And I think a lot of people will probably be, certainly just anecdotally from people I speak to, saying, actually, do I need to rationalize this? Is there any point having five different streaming services, or do I just have one or two of them? And I think that's a key issue that they're going to need to grapple with in order, and that's why subscriber growth is effectively stalling at this moment in time. And it is actually quite remarkable that the share price remains where it is. Yes, they're delivering relatively reliable revenues at this stage, but where's the growth coming from? I think that's the question that they're going to find it difficult to answer.
I think one thing that they do have an advantage over their peers is they do have a big foreign language film market that they can cater for. So Latin America, but also in Asia. And the big difference there is that is probably likely to continue to make up a good proportion of their income. And now they've finally decided, well, I say finally, in the last couple of years, finally decided to hedge their FX income, because they previously didn't do that.
Can I just say, having begun my career in the commercial foreign exchange space, I found it staggering to read that they did not hedge any of their FX risk, as you say, up until about 18 months ago.
Well, I wrote about this 3 or 4 years ago. I wrote about this 3 or 4 years ago when I was at CMC. Why you're not hedging this? Because ultimately you're losing out on billions of dollars of potential profit. But now I think they've suddenly realised the error of their ways, and consequently, they're saying they're expecting to see annual revenue of between $43 and $44 billion based on FX rates to the end of September. So they finally realised that they're basically not taking advantage of that. And consequently, I think that's probably why we've seen the growth in the share price that we've seen over the course of the past 2 or 3 years, despite the fact that we're getting a bit of a plateauing when it comes to subscriber numbers, but they still got 282.7 million. So,
well, exactly. They're not doing too badly. Let's put it that way. They've still got a fairly big chunk of the market, and better late than never that they woke up to the FX side of things.
And an operating margin of 28%. So that's not
which
too
is very
bad.
healthy indeed.
That's very healthy. So, and profits are expected to come in around about $4.17 a share. So, I think the bar needs to be, the bar's already high for Netflix. It'd be interesting to see whether they are able to jump over it. And it does tend to be their weakest quarter, I would say that. So, I'm not expecting great things. I think the guidance will probably be key.
Yes, I would agree with that.
Alrighty. Okay, well, I think we're pretty much done, Michael. I think, unless I've missed anything out, if you want to read a brief summary of what we've discussed today in terms of the week ahead, you can find it on my Substack, MCH Market Insights. It's not difficult to find. And
even I managed to find it, so it must be easy.
And so I think that'll wrap it up for this week, Michael, and I'll see you in probably 3 or 4 weeks' time, because
Indeed, yes,
I'm taking a little bit of a mini break.
Yeah, I was going to say, your liberty of taking a holiday, and I will be joined by an as yet unknown guest this time next week, I suppose.
Indeed, mate. Well, try not to miss me too much. I certainly won't be.
I thought you were going to say try to behave then.
Well, that too.
Oh, I can't guarantee that.
All right, matey. Well, you take care, and I'll see you all again in about 2 or 3 weeks' time.
And enjoy your very well deserved break.
Thank you very much.